In this discussion, we will discuss the discussion question of discuss the process for making a special offer type of decision. When we see a discussion question or essay question such as this, our goal typically is to expand on the discussion or the answer as much as time will allow, it then being more likely that we touch on that information being looked for within an essay question or being able to contribute new information to a discussion, that being the goal for a discussion question. Keeping that in mind, let's go through this one more time. Discuss the process for making a special offer type of decision. First thing we might want to do in order to expand on our topic is to say, all right, a special offer type of decision, that's more of a managerial accounting type of decision as opposed to a financial accounting type of decision. We are focused here on what to do for the business as opposed to how should we record something, which is typically going to be the process for financial accounting. How should we record something in accordance with some kind of standard like generally accepted accounting standards. Here we're thinking about the decision-making process for the tactical move. What do you think the best thing to do for the health of the company is? The decision we're looking into, typical managerial accounting type of decision, a special offer type of decision. A special offer type of decision would be one in which we sell something at a typical type of price and then possibly someone comes in and says, hey, we'll purchase some of these items for some price typically lower than the current price that we usually sell for. So in other words, we set a price for selling our units of inventory, our product, and then someone says, hey, I'll give you a special offer. I'll give you a one-time deal. I want a one-time offer for this type of decision. And we will buy it for this amount. And then the question is, should we sell at this lower price or not? Now, typically when we see this type of question, normally we would firstly think, well, no, I don't think I should sell for that because there's a reason we set the price at what it is. But there might be the case that it could increase our revenue if we were to sell at a special offer. So some things to consider with the special offer. Are we producing at capacity? Can we produce more, in other words, without it adding any cost to us or being relevant cost, no more fixed or overhead type costs? And will the special offer affect our other market type of decisions? In other words, if we were to accept the market offer, even if it was to increase the profit right now, would it upset our current market, who would then say, hey, you gave a special offer to someone else and we're a better customer than they are or whatnot. They came out of nowhere and you gave them a better price than us and whatnot. So that kind of thing could be a harmful decision-making process or harm the decision-making process as well. So those are two things that we would want to consider. The next step, we're going to say, well, maybe if the special offer didn't affect the rest of the market and it covered basically our costs. In other words, there's a profit margin we typically think of, the sales price minus the total costs. Maybe if they gave us something above the costs, even if it wasn't our normal profit margin, we still get some profit margin and that would be good if it's just a one-time situation. If we're not having repeated business with this people, one-time situation, then whatever profit we can get, we can get. And so what if the price was below the total cost? Then you might think, well, we shouldn't accept it then. But that might not be the case as well, because even the total cost that we consider for a unit is usually including things like variable and fixed costs. And the fixed costs that we apply when we say create the sales price or create the cost per unit includes both variable and fixed portion. The cost of the unit includes variable and fixed portion, and the fixed amounts are applied. They're not going to go away if we don't, they're not going to go away if we accept or don't accept the offer. So the question here really is, what are the relevant costs? What are the relevant costs to us accepting or not accepting the offer? And so we're going to have to look at our total cost per unit. We're going to have to basically eliminate those costs that in essence won't go away, those costs that are applied, and then consider whether or not the price is going to be acceptable or something that would contribute to our bottom line. In essence, if we're looking at the cost per unit, if we're looking at the variable costs compared to the sales price, if the special offer sales price is greater than generally the variable costs, it might be something that will benefit and contribute to our bottom line. So in other words, if we can't increase the sales price that's being offered and it's a one-time deal and it was better than and it's more than our variable costs, and we're not producing at capacity, it's not going to affect the rest of our market share and our other customers and our relationships with them, then it may actually increase our bottom line to accept that offer in certain conditions. And you could see this in certain types of industries where it's going to be very apparent in some types of industries. So like, for example, if we had a hotel or something like that, if we owned a hotel, then the cost of people that are staying at the hotel, we have a set sales price. We sell the rooms for a specific amount. We came to that amount by some type of calculation based possibly on cost, saying here's what we think the cost of the room is. Here's our markup. Here's going to be our gain per unit, our gross profit per room. Now, if, however, someone comes in and says, hey, it's midnight right now, I want to stay in a room, and I'll give you basically half the price for the room, well, should we accept that offer or not? Well, you would say, well, no, that's even below the cost of the room. But note that, again, the cost of the hotel room is oftentimes a large percentage of it is basically depreciation or the cost of the building, and that's not going to go away. The only added cost is really the rent or the maintenance on the building. So if it's not going to affect any other customer and the room isn't going to be used either way, you're not at capacity, then it might very well be contributing to our bottom line to have someone be in the room and only as long as they're paying something that's going to be over and above the variable costs, which is in essence the maintenance on the room. So that's going to be the kind of the extreme kind of scenario, because there's going to be a lot of fixed costs in that type of situation. So it's going to differ from place to place depending on the fixed costs versus the variable costs. But that's one example that will and you might want to include some examples of movie theaters, another type of example that you can show to kind of show this effect, where if the movie theater it's not at capacity and the movie's half over, and someone wants to come buy a ticket and watch the second half of the movie, well, you may well be able to sell it to them for half price, and that would contribute to the bottom line, because you're not paying the variable costs of them being in there at that point in time are very low. All the costs of the movie ticket are generally the fixed costs and the overhead that are being applied to it.